Rajeev Thakkar joins us, CIO with PPFAS, joins us after a real long time. Can I add another real? It's been what, almost 6-8 months we haven't had you on the show.
Yes, it's been a while, Nikunj.
Where were you, my friend? Where were you, my friend? Just because Nasdaq is down, you decided not to come on the channel? That's only 20% of your
I get
portfolio.
beaten up at all places, so I'm a bit careful about my security these days.
Good to have you back. What's your market outlook? I'll get into specifics of the fund. Let's first understand from your understanding of where we stand as we unwind 2022 and as 2023 will dawn on us in next 2 weeks.
So I think since we last spoke, a few things have changed fundamentally, and it's actually back to normal, as I would call it. One is that the period of persistent real negative rates, where inflation rules above the interest rates and savers and debt investors get nothing, that has gone behind us. That is point number one. The second thing that has changed is that the endless amount of money which would get pumped in on future promises, where startup kind of companies or even companies which have been around for 5 years, 10 years, but not showing cash flows or profits, those people who are getting funding, those days are over. So going forward, I think one has to be extremely mindful of the valuations that one is paying for the companies that we are buying, or even the companies that are in the portfolio of people. People should take a hard look at what valuations are there, what cash flows are there in the near term, and not just depend on future promises. If we keep these 2 points aside mainly, things are pretty normal. Like in any market condition, there are pockets of overvaluations and there are pockets of things which are looking reasonably attractive. So both coexist in the marketplace. One place which is confounding me personally, where historically we have not been investors, has been the PSU space, where valuations are very, very attractive. There have been issues in terms of there not being shareholder friendly, but with the privatization drive kicking off, I think that space could look interesting in the coming year or so. So that's the broad outlook and the way I'm looking at things.
I just missed the last part. Are you saying that PSU banks where the divestment could happen, they are potentially looking attractive to you?
Not PSU banks, PSU as a basket completely, irrespective of sectors. So be it logistics, be it metals and mining, be it banks, across the board. So for a long time, people just spoke about privatizing Air India, for example. We have recently seen the action where they have actually gone out and sold it, and a few more are in the pipeline. So cheap asset valuations at one end and change in management at the other end could be real possibilities. So if those two get combined, then you could see interesting opportunities in that space. Historically, there have been issues in terms of the management not being shareholder friendly and stuff like that, or not being growth oriented. Those things could change.
Rajeev, now let's put the spotlight on you. What about your holdings in overseas securities, Alphabet, Microsoft, Amazon, Meta? How have you dealt with the meltdown in some of these names in the year gone by?
Sure. So, given that we have a mix of India plus overseas, any one segment doing too well or too badly does not overall affect the portfolio much. So, we would be ballpark, I would think, down about 2% odd in terms of the 1 year returns kind of thing. So, it's not as bad as it sounds. And we have been saying this from day one. So we launched 9.5 years back. We have been saying this from day one, saying that when India does much better than overseas stocks, the scheme will tend to underperform. And when there are India-specific events like border tension with China or demonetization or GST introduction or something like that, the scheme will do better. But we urge investors to look at it across the cycle. Specifically talking about the stocks that you mentioned, these stocks were not overvalued even at the highs that we saw last year. So if we look at companies like Microsoft that you mentioned or Alphabet, these were around 30 times earnings, more or less, before the fall. After the fall, these are around 20 times earnings. And these are exceptional companies in terms of the monopoly or the oligopoly kind of businesses that they are in. Despite the overall slowdown in the GDP growth rate, which is expected in the coming days, their underlying business is showing some growth. Sure, in the heady days of 2020 and 21, these companies were a bit lax on their cost control and hiring. They were budgeting for a much higher growth rate. So they are paring down their costs in terms of their P&L. But the underlying trends that we saw over the last 5 years, 7 years, be it shift from linear TV to streaming, be it shift from traditional advertising to digital, physical commerce to e-commerce, all of those trends are continuing. Cloud computing, on-premise to cloud computing. All of those trends are continuing and are expected to continue in the next 5 years, 10 years. So fundamentally, we like the space very much. Currently, we are constrained in terms of not being able to buy more, but we are surely holding on to our existing investments there.
Question. I mean, you're constrained because of regulatory factors where you can't buy more, and the temptation to buy after this kind of a fall is obviously there. So what should investors do? I mean, there's nothing they can do.
Hold on. I don't think investors need to do too much. One change that investors definitely should do, and I would urge people to really look at their asset allocation afresh. For a long time, there is this belief that if you invest in equity and forget it, you can't lose money over 3 or 5 year periods. We haven't seen a negative year in equity for some time now. So I would suspect that people have lesser amount in debt as compared to what they actually need, depending on their age and risk appetite. I'm not saying get out of equity. I'm just saying that don't keep near-term money in equity, because equity can be choppy, and there is some complacency that I see when talking to investors and when talking to advisors, that oh, it's okay if we are overweight on equity and things typically bounce back. I think that premise can be challenged, and debt rates have become attractive. So CDs, for example, on a 1 year basis are already at 7.5%. So debt rates have moved up and have become somewhat attractive.
What about, Rajeev, the homegrown IT stocks? Because they too have gotten into a bit of a sticky spot. You had a guidance revision come in from HCL Technologies, and clearly that's not where you've made money in the last 6 months.
True. So I was talking to someone in the industry, and that person made a very, very interesting point. The IT sector as such is very well governed in India, and even if you come down the pecking order, the chances of getting into a badly governed company is much lesser. And maybe something like a Satyam was an exception in the industry. Some other sectors typically have issues in terms of capital allocation and governance and stuff like that. So sure, in terms of near-term demand, these companies are going through some challenging times, but the underlying thing in terms of being an asset-light business, in terms of growth opportunity, in terms of good quality governance, all those things are there. The famous phrase that was used quite often in the last few years is that software is eating the world. And that is true. Today, even if you are a traditional company like, let's say, a HDFC Bank or a ICICI Bank or a Axis Bank, you have to have a digital strategy, and you are competing with the likes of, let's say, a Paytm or Policy Bazaar or something like that. So every company needs to have a digital strategy. I don't think the demand destruction is permanent. It's a cyclical thing. And one has to wait out the near-term headwinds. Of course, some valuations had gone up beyond comfort zone. So especially in the mid-cap IT space, to which we sold out almost completely in the last 2 years. But overall, I don't see too much of an issue. There may be near-term pains, I think, but this sector is reasonably attractive.
Okay, that's the outlook coming in, saying software is really eating the world, and that holds true. Rajeev, what about the entire commodities space? Given that a lot of these stocks within the metals sector have been in the spotlight, what's the take in the long haul?
So commodity, the outlook can be at best for a quarter or two. That's the nature of the industry. One cannot have a very, very longer term outlook. Energy basket, I think, given that the geopolitical tensions are there, and again, just yesterday, one of the leading foreign banks has announced that they will not be funding fresh oil and gas projects. What has happened is everyone is given up on the fossil fuel space, and everyone is saying renewable energies are the future. But in the near term, in the transition period, I think the world is going through a shortage of energy. So that space in the commodity cycle looks attractive in the medium term. Metals, I think, should be in a range. I think they have corrected significantly from the highs that we saw. I don't have a very strong view on the metal space either way.
Is there a conscious decision as well not to venture into the entire infrastructure or capital goods space?
So in infrastructure, the promise has been there for as long as I can remember, since the start of my professional investing career, which is 20 years. It has always looked promising. The issue has been that it has been capital intensive. There have been ups and downs in terms of policy changes and things like that. So it's a sector which is building the country, and I'm happy that all this infrastructure work is happening. But I'm not very, very clear on how to make money investing in that sector. Capital goods, yes, the cycle is about to turn, and we are seeing revival in capital expenditure, but probably the stock prices in most companies have already gone up in anticipation of that. So we are watching this space, both capital goods and infrastructure, but right now we don't have any executable ideas, at least to our team.
Good morning, Rajeev. You've often been talked about how you like to invest in tech companies. You own a Microsoft, you own an Apple. And you've always said that India's new age companies now that flocked to the Lal Street last year are very different. That you will only look at them when they're profitable. The question I want to ask from you is that from a Zomato to a Paytm to a Nykaa, delivery, they've all come out now with timelines on profitability. You've seen bonus splits. You've seen a buyback now in the case of Paytm. Are you now re-looking at any of them?
We are continuously looking at them. So I think one cannot ignore the startups, and one cannot ignore what they are trying to do. And potentially there could be network effects coming in, or some, let's say, something like a cloud kitchen or something like a private label brand in some company, or various possibilities are there. But we would like to see the execution on the ground first. So that is one. And secondly, one cannot ignore the traditional players. So today, when we are excited about the fintechs, for example, where you can download an app and get banking, the same features, same facilities are available from the incumbent private sector banks. So today you can do a online KYC and open a bank account end to end within 15 minutes. And those people, in fact, have better things to offer. So if you down the road need a checkbook or a physical debit card or things like that, you can actually get those. Or if you need to walk in a branch, those branches are there. So I'm not writing off the incumbents. I'm not writing off the startups. It's a space we are continuously watching. But and it's a good thing that they are now focused on cash flows and profitability. But we will wait for those to be executed, and for us to be able to meaningful sense of the valuations that are there.
Fair point. And if I see your top holdings as well, you've got, and I'm talking about now the non-US tech companies from the financial space, and because we're talking a bit about banking, where there's PSU banks of banking at large, you've got an ICICI Bank, you have Bajaj Holdings also, I see, and Axis Bank as well. But since you seem to be changing your mind about PSUs, with PSU banks in particular, is that going to be the big theme that is for the new year? Has it already started? Have you bought any of these PSU banking counters, the smaller ones, the larger ones?
So as you can see from the fact sheet, PSU banks are not in the space right now. We own a few PSUs in other spaces. So we have investments in Coal India and Power Grid, for example. So we have investments in the PSUs, which were missing for some time in the past. As far as the banks are concerned, I think selling IDBI may be relatively easy, IDBI Bank. For the other nationalized banks, I think it will require a legislation change and approval from the parliament. So it may not be as easy to privatize public sector banks. So I think the privatization drive may be in the non-banking space in the initial period at least. At least that's what I see in the coming year or two.
All right, Rajeev, good to have you back. Hopefully, we'll not wait for 6 months to have the next interview.
Sure. Hopefully, Nasdaq goes up faster so I can come faster.
All right, really appreciate your time and so glad you could join us.